Have you ever wondered why housing prices seem to keep rising even when it feels like they should be slowing down? Pretty sure most of the country feels that way right now. Or why sometimes they suddenly drop out of nowhere? What if I told you that the secret lies not in economic factors like interest rates or income, but in something much more intriguing and often overlooked? Today, I'm uncovering the hidden force driving the housing market. People's expectations of future prices. It's that simple. That's right. What you and I think will happen to the housing prices tomorrow is shaping what happens today. This concept creates a powerful feedback loop that can push prices higher or send them crashing down. But here's the kicker. Despite its enormous impact, most economists tend to ignore it. But why? Because it's tough to measure and even tougher to predict. But if you can understand this one crucial element, you could have the upper hand in one of the most unpredictable markets out there. Imagine being able to predict the next big move in the housing market just by understanding how expectations work. It sounds almost too good to be true, doesn't it? Well, stick around because we're about to dive deep into this mystery. I'm going to reveal how your thoughts on future prices could be the key to making smarter buying and selling decisions today. By the end of this video, you'll have the insights you need to navigate the housing market like a pro. Welcome back to my channel. Today I'm diving back into the world of the housing market. Have you ever wondered why housing prices keep going up and sometimes why they suddenly drop? Well, the secret lies in a powerful feedback loop driven by people's expectations. Let's start with a basic question. What are housing price expectations? Simply put, it's what people think will happen to housing prices in the future. If they believe prices will go up, they will rush to buy now, increasing demand and pushing prices higher. On the flip side, if they think prices will drop, they will hold off buying, reducing demand and causing prices to fall. The expectation-driven behavior creates a feedback loop. Economists have studied this phenomenon extensively, but they call it by many names. Price extrapolation, adaptive expectations, and even irrational exuberance. Despite the jargon, the concept is simple and incredibly powerful. So how does this feedback loop work in practice? When people expect prices to rise, they act quickly to buy homes before prices go any higher. This surge in demand pushes price higher. As prices climb, more people become convinced that prices will continue to rise. So even more buyers enter the market, further driving up prices. It's a self-reinforcing cycle. Sounds a lot like FOMO. Interestingly, the same logic applies in the reverse. If people expect prices to fall, they delay buying, reducing demand and causing prices to drop. This lowered demand then reinforces the expectation of falling prices, creating a downward spiral. Do you know the definition of inertia? Objects in motion stay in motion, and objects at rest stay at rest. This phenomenon we're speaking about is known as inertia in the housing market. Higher prices lead to higher prices, and lower prices lead to lower prices. It's a bit like a snowball effect. This inertia can make the housing market very unpredictable and volatile. Economists traditionally focus on fundamentals like interest rates, household income, and population growth to explain housing prices. However, they often overlook the role of future price expectation. This oversight can lead to misunderstandings about what actually drives market changes. Look, we have had many call for a crash for the last several years. We just had Case-Shiller come out and report another 7% year over year in gain. Exactly what we're talking about. Clearly, most of the talking heads are not taking this into consideration whatsoever. Research by Case-Shiller back in 1989 highlighted that price momentum in the housing market is stronger and lasts longer than in most other asset markets. We've actually talked about this in another video. The illiquidity of the housing market plays a role in this. If you'd like to watch that video, I'll put that link in the description below. They found that 1% change in a year is correlated with a 0.3 to 0.75% change in the following year. This momentum can persist for 2 to 3 years before prices revert back to the mean. Another study done by Adam Guerin of Harvard in 2014 reinforces the findings showing that people's expectations significantly impact housing prices. Despite the clear evidence, future price expectations are still often ignored in mainstream economic models. So, what does this mean for you as a buyer or a seller? If you're looking to buy, understanding market expectations can help you make better decisions about timing. Are people expecting prices to rise? It might be wise to buy sooner rather than later. Conversely, if prices are expected to fall, waiting could save you money. For sellers, knowing market sentiment can help you decide when to list your property. If prices are expected to rise, holding off for a bit may yield a higher sales price. If a downturn is expected, it could be beneficial to sell even sooner. In conclusion, future price expectations play a crucial role in the housing market, creating a powerful feedback loop that drives prices up and down. By understanding this dynamic, you can make more informed decisions whether you're buying or whether you're selling. That's it for today. Thank you for watching. This was another guaranteed video. If you found this video helpful, please do me a favor. Please give it a thumbs up, share it with your friends, and subscribe to my channel for more insights into the housing market. Hit the notification bell so you never miss any update. Until next time, happy house hunting. Have a great day.